let's begin. We're going to start with employee stock options. Okay, so under this chapter, your questions are going to be focused on calculation of employee stock option expenses and journal entries. So your questions are predominantly revolving around these two areas. So what is employee stock options? The option is given to the employee to purchase the shares of the company at a price which is comparatively less than the market price. Right, so this option, however, is subject to fulfillment of certain conditions. Okay, when we say certain conditions, the conditions have a period for by which they will get fulfilled. So assume the today the options are getting started. The start date is called as the grant of the option. Okay, the start date is called as the date of grant or grant date. And once the options are granted, the conditions begin to apply. The period by which the conditions need to be completed are called as the vesting period. VESTING is called as the vesting period. So that is the period by which the conditions are expected to be satisfied or completed. Now once the options are satisfying the conditions, they are called as vested options. Okay, so granted options is starting. Once those satisfy the conditions, they are called as vested options. Now, in between, some employees may not satisfy the condition and they will be coming into the category called as unvested options. Okay, so these are the two parts for condition fulfillment. Now, after fulfillment of condition, the employee has the option to purchase the share or take up the share. Now, when we say option to purchase or take up the share, then in that case they are called as exercisable options. Okay, again there is a time period. You after the completion of vesting period, there is a time that is given for which the options will be available for exercise, and that period, within that period, if you are not going to exercise the options, then they will lapse, which means the options will not become eligible. So grant, after that we have the vesting period. After the vesting period, exercise period happens. Now during the vesting period itself, some options become ineligible and they are called as unvested lapsed options. And after the vesting period, if some options become, if some options are not getting exercised because the employee doesn't want it, then they are called as vested lapsed options. Right, so now, the rule here is to recognize the employee stock option expenses at the fair value of the option granted. What is meant by fair value or intrinsic value of the option granted? It is nothing but the benefit that you are passing on to the employee. If the employee wants to purchase the company share from the outside market, he has to go by the market price. However, the company is offering at a lower price. So that differential factor is the benefit that is passed on to the employee, which is a cost to the company. That cost is recognized as the fair value of the option or intrinsic value of the option. So fair value of the option is nothing but market price as on the date of grant minus exercise price. Okay, so fair value minus market price minus exercise price. Now what will happen? This fair value of the option will be recognized as cost in the books of the company. But what if the period of the option is for more than 1 year? Say suppose the conditions are to be fulfilled for 3 years. Now if it is for 3 years, the options need to be spread over the period of 3 years. So naturally the expense will be spread and recognized over a period of 3 years. Right? So the fair value of the options granted shall be recognized as expense over the vesting period. Okay, the exercise period is not relevant for us. Only the vesting period is relevant for us. Suppose the company gives the options for 3 years, after which the employee has 1 year for exercise. That 1 year is not relevant. We are only worried about the 3 years for which we grant the option. Okay, so the proportion has to be made over the vesting period. One second. Am I audible now? I think some of you are saying that my voice is not audible. So the expenses that are going to be recognized are going to be spread over the vesting period. Now for the options which are getting unvested, which means without fulfillment of conditions itself, they are getting lapsed or lapsed after fulfillment of conditions. For that, the expense will be reversed in the books of accounts. Okay, the expense will be reversed accordingly in the books of accounts. Moving on to the journal entries. When the options are granted, the expense is recognized not on the grant date, but at the end of the year. At the end of the year, the expenses are recognized in the books of accounts. Okay. Now the expenses will be recorded for as ESOP expenses account debit to ESOP outstanding to the extent of options vesting during the year. In other words, if there are any unvested options during the year, you can net it off and the net amount can be considered for the amount of expenses to be recognized. So we can make a note of it. Yes, unvested options can be reversed. Okay, so ESOP expenses account debit to ESOP outstanding. And the expenses is transferred to P&L account. So P&L account debit to ESOP expenses. Year on year, this entry will be passed for the vesting period. Now, ESOP outstanding is a accumulation entry liability which will be shown in the balance sheet under other non-current liabilities. Okay, it will be shown under other non-current liabilities. Now, when the options are exercisable, so vesting period is over. For the options that we are going to exercise, bank account debit for the amount received from the employee, which is the exercise price into options availed. Okay, exercise price into options availed. ESOP outstanding account debit, fair value into options availed, which is nothing but the difference between your market price and exercise price. To equity share capital at the face value and securities premium for the balance amount. Okay. So this is your entry for subscription where the employees exercise the vested options. Next, once it is vested, if it is not availed, which is if it is lapsed, in that case, entry is reversed. ESOP outstanding, the entry is reversed, but we cannot take it to P&L account because it pertains to the expenses of previous years. So we are going to transfer it to general reserve. So ESOP outstanding account debit to general reserve for vested options not availed or lapsed. Because the conditions are fulfilled but the employee is not exercising the option. It is reversal of profits of the previous year. Okay, ESOP outstanding account will get closed after the transfer to general reserve, which means vested plus unvested together will close your ESOP outstanding. Sorry, vested exercised plus vested lapsed will together close your ESOP outstanding account. Okay. However, if the options are lapsed during the year, like I told you, the expense will be reversed in the same year. So instead, we can directly net off and pass the entry as one entry in the end of the year itself. So effectively, you have to remember 3 entries. At the time of exercise, what is the, sorry, at the time of grant, at the end of the year, the entry is going to be ESOP expenses to ESOP outstanding and P&L to ESOP expenses. Second, when the options are vested and they are exercised, bank account debit, ESOP outstanding account debit to share capital to securities premium. And when the options that are vested are lapsed, then ESOP outstanding account debit to general reserve. Unvested options are reversed along with the first entry itself. So you can net off and write it as a single entry itself instead of writing the whole amount and then reversing. Okay, because the entry is passed at the end of the year, by the end the unvested options can be reversed. Question time. Question number 1. What is vesting? What is vesting? Define the following terms. Vesting means fulfillment of conditions for the employee stock options to be availed. The period for which it is going to be fulfilled is called as the vesting period. Second, grant date. The period or the date on which the employee options is initiated or announced to the employees, offered to the employees. Exercise price. The price at which the shares are offered to the employees. Clear with the terms? Okay. Second question. Noor Limited has its share capital divided into equity shares of rupees 10 each. On 1/1/2021, it granted 4,000 employee stock options at 40 rupees per share. Market price was 60. Fair value of the option is therefore 20. Unset, so we can directly calculate also. Options were exercised between 15th March and 31st March. The employees exercised their options for 2,500 shares only and the remaining options lapsed. Okay, so out of total 4,000 options, 2,500 was only exercised and the remaining lapsed. Company closes its accounts on 31st March every year. You're required to give the journal entries as on 31st March. So the options are granted from 1/1. Okay, and the same year, within the same year itself, the options are getting vested. So the entire expense of ESOP will be recognized in the same year. So please pass the journal entries. First, start with expenses recognition as on 31st March. Net. No, no. Here it is vested and vested lapse. So separately will you read the question fully. Don't jump to the answer without reading the question. Yes, yes, definitely. So ESOP expenses to ESOP outstanding, P&L to, then bank entry, then reversal entry. Knocked off, you can do it in the same year. You can combine and write it as one entry. Yeah. So can we go to the answers? Your entry for first entry will be ideally what? Employee expense entry. First create the expense entry. ESOP expenses account debit to ESOP outstanding. The amount is going to be 20 rupees into 4,000, which is 80,000, right? 80,000 rupees. Okay. Second entry, bank entry. Bank account debit 1 lakh, which is 2,500 into 40. Employee stock compensation expenses or ESOP expenses account debit 50,000, which is 2,500 shares into 50. Two equity share capital 25,000, 2,500 into 10. Two securities premium 1 lakh 25,000. Narration mandatory. Wherever you have journal entries, do not skip out on narrations. Okay. Next. So we have passed the entry for ESOP to ESOP outstanding. We have passed the bank entry. Third entry. What is the third entry? The third entry is going to be for reversal. Now reversal of 1,500 options. Correct? 1,500 options at 40 rupees, 20 rupees. So what will be the amount? 1,500 into 20, 30,000. So the journal entry is going to be ESOP outstanding account debit to ESOP outstanding account debit to general reserve. But here, since it is in the same financial year, we can write it as P&L account. It happens in the same financial year. Normally, if it is in the next financial year, we need to write it as general reserve. So since it is in the same financial year, it is P&L account. Okay. So ESOP outstanding account debit to P&L account 30,000, which gives your net impact in P&L account as profit and loss account debit to ESOP expenses 50,000. Again, you have reversed separately. But preferably combine and write if it is in the same year. Right? Clear with the journal entries? So the net impact in P&L account is 50,000. Can we do one question next for calculation of the ESOP expenses across years? Okay. At the beginning of the year, question number 2. At the beginning of year 1, Harmony Limited grants 600 options to each of its 1,000 employees. The contractual life of option is 6 years. Vesting period 3 years. Exercise period 3 years. So what is the period for which we will recognize the expense? 3 years being the vesting period. Okay. Expected life is 5 years. Doesn't matter. Exercise price 100, market price 100. So exercise price and market price are the same. Expected forfeitures per year is 3. Okay. Expected forfeiture here indicates the options which are unvested. Right? Next. The option granted. Yeah. The option granted vest according to a graded schedule. So graded vesting is a concept where the options do not get eligible at once. They get eligible over a period of time. Some options get eligible in the year 1, some in year 2, some in year 3. So where the eligibility of the options change according to the period. So the options granted vest according to a graded schedule, which is 25% at year 1, 25% at year 2, and the remaining at the end of year 3. So which means out of the total options, 1/4 is vesting, or 1/4 is becoming eligible at the end of year 1, 1/4 at the end of year 2, and remaining at the end of year 3. So for the first 1/4, 1 year only cost will be recognized. For the second 1/4 or second 25%, 2 years cost will be recognized. And for the next 50%, 3 years cost will be recognized. Clear? You are required to calculate the total compensation expenses for the options expected to vest and cost at a cumulative cost and cumulative cost to be recognized at the end of 3 years, assuming the rate does not change and the intrinsic value is ₹7. In this question, the exercise price and market price is the same, but the option itself is given that there is an intrinsic value which is at ₹7. So we will use this ₹7 as the basis for calculation of fair value of the option or employee option expenses, right? So the first thing that we are going to do is calculate the amount of options vesting at the end of each year. Year 1, no, okay, 3% is exclusive. Year 1, let's understand, 600 options to its 1000 employees. So total number of options is going to be 6 lakhs. 6 lakhs options, of which 25% alone will be vested. Correct? So 6 lakhs into 25% is vested. Okay. Of which 3% will become unvested. So what will be the actual vesting at the end of the year? 97% alone will be actually vested. So 97%, which gives you 1,45,500 options. 1,45,500 options. Year 2. Okay. Year 2, another out of the 6 lakhs, another 25% is getting vested. Okay. Remember, already the 1,45,500 options are open. So another 25% is getting vested, out of which what will be the actual vesting after the lapse? Again, expected forfeiture is 3% for each year. So first year 3% would have gone. Second year another 3% would have gone. So first year into 97%, of which only 97% will be there for second year. I repeat, 6 lakh options into 25% is the vesting. This vesting is happening in 2 years, of which first year, end of first year, 3% will lapse. So remove 3%. We are left with 145,500. In that 145,500, end of year 2, another 3% will lapse. So remove that 3% also. So 2 times we are going to apply the percentage, because it is given as expected forfeiture per year. It will go on a cumulative basis. What is the number of options? 1,41,135. Okay. Year 3, 6 lakhs into 50% into year 1, 3% is lost. Year 2 again 3% is lost. Year 3 again 3% is lost. 2,73,802 options. What is your doubt? Now, for 145,500 options of year 1, the vesting period is only 1 year. Okay. So expenses will be recognized for this 1,45,500 for 1 year. Okay. For the second set of options, which is 141, 135 options, vesting period is 2 years, for which expenses will be recognized for 2 years, spread over 2 years. And for this third year, okay, the vesting period is 3 full years, so expenses will be recognized over the 3 years proportionately. Right? We will come to it. Please wait. Okay. Now, coming to the expense. Year 1, what is the expense? Okay, in year 1, see, in year 1, for the first 25 percentage we need to recognize, second 25 also we need to recognize, third 25 also we need to recognize. Correct? So, we will say 1,45,500 options into 7 rupees per option. Correct? Okay. Plus, for the second year, 1,41,135 options into 7, but that amount is going to be split and recognized over 2 years, so into 1/2. Second year oda 141, 135 options has 2 years vesting period, so we need to divide it by 2. Third, 273, 802 options into 7 rupees will vest in 3 years. So first year we are going to take it as into 1/3. 1 year only, right? First year only we are doing, so into 1/3 total, and give me the answer. First year, total 3 years, out of which first year we are recognizing, so 1/3. 1/3 is because we are in year 1. We are going to recognize that 50 percentage option over 3 years, which means in year 1, 1 year expense only will be recorded, so into 1/3. Next year pandrache you will understand the difference. 21. Okay, 343.5, yeah, something like that. Okay, 344. Right? Now listen carefully for year 2. This is where you need to focus. Year 2 and 3. Year 2, first 1,45,500 options are we going to recognize? No. So leave it. For 1,41,135 options, we are going to recognize for 7 rupees. Okay, for the entire 2 years. So as it is. So into 2/2. So I am leaving it as it is. Please wait, please wait, please. Okay. Next, for the third year set of options, which is 273,802, I am going to record at 7 rupees. Of 3 years, I am going to recognize for 2 years. So here I will write into 2/3. The value that you get. What is the value that you get? 2265. 2265,688. Of which 2265,688 is the total cumulative value up to year 2, of which 2151,344 is already recognized in year 1, which gives us the difference of 114,344. So this is your expense for year 2. Now coming to year 3. Okay. Okay, 1 minute. When we are taking cumulative, we should have added this also, no? 145, 500 into 7. Because when we are taking cumulative, I'm sorry, in year 2, when we are taking cumulative, we should have added first year plus second year plus third year. Then subtract whatever we have recognized in the first year. So I think this number will change. Calculate and tell me, sorry. 32, 84, 188 minus 2151, 344, which gives you 11,32, 844. Now third year, let's calculate the cumulative value. Cumulative value means for all the 3 years put together, what is the total expense? 145, 500 into 7 plus 141, 135 into 7 plus 273, 802 into 7 minus whatever is the total expense recognized for year 1 and year 2, which is 32, 84, 188. Six lakh 38, 871. Okay. So I am repeating the calculation again. Please listen once. Year 1, expenses for year 1, year 2, year 3, whatever we need to take, we have considered. So 145, 500 into 7 plus 141, 135 into 7 into 1 by 2, proportionate. And 273, 802 into 7 into 1 by 3. So the total amount is 2151, 344. Year 2, we are going to go on a cumulative basis. Cumulative means what? Whatever I have recognized in year 1 plus what I need to recognize in year 2. So what I have recognized in year 1, 145, 500 into 7 plus 141, 130, 141, 135 into 7. Already 1 by 2 I have recognized. Now year 2 I need to take. So into 2 by 2 plus 273, 802 into 7. 1 year already recognized. Now second year I am going to recognize. So into 2 by 3, which gives you 32, 84, 188 minus 21, 51, 344, which is 11, 32, 844. And third year, total expenses for 3 years. So 145, 500 into 7, 141, 135 into 7, 273, 802 into 7, minus whatever you have recognized up to 2 years, gives you the final answer. Okay. So this is your vesting calculation. Always do cumulative calculation. Never do independent calculation for the years. Always do cumulative calculation. Year 1, do year 1 alone. Year 2, do year 1 plus year 2 minus whatever has been recognized. So only if you do cumulative calculation, it becomes easy for calculating the vesting value. Take down. Small chapter. Esop generally is not asking 10 marks, but if they ask 10 marks, they will ask both working and journal entries together. Yeah. that sum, they will ask for 10 marks. Now they will ask both working out and journal entries together. But mostly they'll ask தெரியாது. Okay. Clear with the provisions? So only rule that you remember here is for calculating the vested options and value for each year, go by cumulative method. Never go by year on year method. Go always by cumulative method for calculation of expenses. Year on year, here you can do, your answer will be correct. Suppose if the options values are changing, then it will become, so if in between, if there is a lapse, vested lapse irundaduna, then your answers will change. So if you do cumulative, whichever method situation is there, vested lapse irundhalum seri, unvested lapse irundhalum seri, graded vesting irundhalum seri, edhu pannalume for cumulative method answers will always be correct. Here year on year if you do, you have to do for second year 1 by 2, 1 by 3 எடுத்துக்கணும். Third year ஒரு value மட்டும் எடுத்துக்கணும். Here in this question answers will match, but not in all other questions. Especially if you have a lapse question, answers will not match. So it is better to go by the cumulative approach. Okay, right? So this summarizes employee stock options. Any doubts? Next, we move on to the next simple topic, buyback of shares. Okay, what is buyback? Buyback is a voluntary process by which the equity share capital of the of the company is taken back. It is a voluntary process. While redemption is a mandatory process, buyback is a voluntary process. Okay, buyback needs to be authorized by the articles. There must be a board resolution and a special resolution that is to be passed in the general meeting. The shares, equity shares before buying back should be fully paid up shares, which means partly paid up shares cannot be bought back. You cannot buy back the shares that have been issued within a period of 12 months. Okay, so in the same period, I cannot have an issue of the same kind of shares and buyback of the same kind of shares within 12 months period. But it can be of different kind. Like I can issue preference and buy back equity, which is possible. Settlement has to be made for buyback through cash. So these are the major terms that are governing under Companies Act. 1 minute, friends. Now we are going to continue with the conditions that have to be tested numerically for buyback. 3 conditions. Okay, first, the maximum number of shares bought back cannot exceed 25% of the equity share capital, which is number of shares. Second, the maximum shares bought back cannot exceed the 25% of the paid up capital plus free reserves. Paid up capital plus free reserves. Okay. Second, or the third condition rather, after completion of buyback, the debt equity ratio of the company cannot exceed 2:1, which means the debt of the company should not be more than 2 times of the equity. When I say equity, it includes share capital, free reserves and securities premium, but it will not include capital reserve, capital redemption reserve, all this non-free reserves. Okay. Can I issue any other shares and buy back? Which means, can I issue preference shares for equity buyback? Yes. Okay. If buyback is made without issue of any shares, then an amount equal to the face value of shares bought back needs to be transferred to CRR, which is capital redemption reserve. However, if you are issuing fresh shares, okay, if you are issuing fresh shares for the purpose of buyback, CRR need not be created to the extent of face value of fresh shares issued. Okay. So CRR creation formula will be CRR is equal to face value of equity bought back minus face value of shares issued, which is of different class. Yes, because buyback is allowed, sorry, securities premium can be utilized for the purpose of buyback according to the Companies Act. So for buyback redemption in the sections two, securities premium is considered as a free reserve. Will include. Revaluation reserve will ideally not be included as a free reserve, provided question says otherwise. The question says it is freely available, then you can use it. Very rarely such scenario will come. But if nothing is mentioned, do not touch revaluation reserve. Capital reserve, revaluation reserve, investment development reserve, uh, sorry, infrastructure development reserve, investment fluctuation reserve, idellame non-free reserves. Okay? Right? So you can take down the conditions wherever relevant. So what are the rules that we need to remember? 3 conditions for testing buyback and creation of CRR for the purpose of buyback. These are the points that we need to remember from the accounting perspective. Journal entries. At the time of buyback, equity share capital account debit, premium on buyback to equity shareholders. Next, when the equity shareholders are settled, equity shareholders account debit to bank account. And when it is transferred to CRR. Now friends, remember, premium on buyback can be settled from securities premium. But CRR creation cannot happen from securities premium. Okay. For CRR creation, you can only use general reserve or P&L. But for premium on buyback, you can use securities premium, general reserve or P&L, whichever is available. So transfer to CRR, general reserve account debit or P&L account debit to CRR. And for write-off of premium, securities premium, if available, then general reserve or P&L account debit to premium on buyback. To premium on buyback. Right? So these are your journal entries. Now, the most commonly tested area is to calculate the number of shares that needs to be bought back, and for which we will test 3 conditions. And the 3 conditions I have given you as a formula. Condition number 1, equity shares to be bought back is 25% of equity shares outstanding. Condition number 2, adula rendu formula irukku. Okay, first formula is resources available for buyback is equal to 25% of equity capital plus securities premium plus free reserves. Preference will not be added, please remember. Equity capital plus securities premium plus free reserves. And to calculate the number of shares that needs to be bought back, we are going to take resources that is available, which is answer that you get under formula A, divided by buyback price. Price of the share for buyback. Not face value, by buyback price. So A lower number of share, test number 1 lower number of shares we have got. Test number 2 we have got number of shares. Now test number 3 is very important. Okay. Debt equity ratio. Minimum equity required is equal to, so I have split it into 4 formulae. Minimum equity required is equal to loan funds divided by 2. Okay, total loan funds, long-term loan. Please consider long-term loan, short-term loans need not be considered. Resources available for buyback is equal to present equity, which is present equity plus securities premium plus free reserves, which is nothing but what you found out in test 2, minus minimum equity required, if there is a minimum criteria to be maintained. What is that minimum criteria to be maintained? Value that you got in formula A. Formula A, minimum equity required. Okay, so this formula A is what we need to subtract. Clear with the two formulas so far? Third, assuming the number of buyback shares is X, okay, number of shares is X, CRR required is equal to face value into X. So CRR needs to be created. And buyback value is equal to buyback price into X. Okay, so if face value is 10 and buyback price is 30, CRR required will be 10x, buyback price will be 30x, or buyback value will be 30x. Now to the final option, resources available for buyback is equal to buyback value plus CRR required. This is the equation, which is B is equal to C. Okay, so resources available for buyback is equal to buyback value plus CRR required, and if you solve for X, you will get the answer under number of equity shares. Okay, so this gives you the formula for debt equity ratio test. Now the answer will be minimum of the three, least of the three. Whichever is less will be the number of shares that we need to issue. Whichever is less of the three conditions. We are having some network issue.